Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by the host and the podcast guests are solely their own opinions and do not reflect the opinion of Devonshire Partners, LLC, or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Cody Payne, an SVP at Colliers and an expert on what is an emerging asset class within real estate, flex industrial. This is a little bit of a different podcast where we dive into this corner of the commercial real estate market and discuss why Cody thinks it could become a real institutional asset class. In this informative discussion, we covered what flex industrial space consists of, the degree of institutional interest in the space today, the positive attributes Cody thinks that flex industrial space offers investors, current supply-demand dynamics in the market, and the book that Cody and his team wrote about flex industrial real estate. And without any further ado, here's my conversation with Cody Payne of Colliers. This is going to be a little bit of a different podcast in that we're going to talk about what might be an underappreciated asset class that has the potential to compound at high rates. But Cody, let's start off with a little about you, your background, and what exactly you do at Colliers today.
Yeah, no, hey, thanks for having me on, Ben. So what I do is we actually specialize in selling small bay industrial investment parks. So it's kind of looked at as the multifamily of industrial. I got a great team here, and we've done it for a long time. Started my career in it in 2005 and still going strong today.
Interesting. How has the asset class, from your perspective, changed since 2005 when you started?
Well, so 2005, I don't know if I told you this, actually, I was a leasing agent at that time. And so I was doing a lot more leasing. I'll tell you, the average tenant size was much larger at that point. Maybe you were kind of dealing with with larger guys. There wasn't as much small bay. Over time, that tenant size really shrunk down to, 1,800, 2,000 square feet is kind of the sweet spot, the large tenant pool range. And then, we always say since COVID, it really kind of exploded the asset class by bringing in, retail tenants, office tenants, showroom tenants. And so it kind of created it to where it has a really diverse tenant pool, which I think in any, a lot of people go for stock, go from wherever and invest in real estate, and they always look for what's a safe asset that they can make money on. Well, this one, I believe, it has the most diverse tenant pool, which whenever you look at all real estate assets, I mean, if you're doing office space, you're leasing office guys. If you're doing multifamily, or you're leasing the household. This one can actually pull from retail, from showroom, from office, from light industrial. So it's the only commercial real estate asset class that pulls from all those guys. And so that's actually what I think makes it most unique nowadays.
So let's dive into that a little bit. So if I'm one of those different classes of business, what do I use, small bay / flex industrial space for?
I mean, that could be used for anything. So I'll just give you a prime example. We just sold a park, actually, just north of here. It had a tumble and cheer studio. It had a car wrap shop. It had a body shop in there. It had a high-end bakery in there that moved from a retail center. It even had a logistics company in there, had window tinting. It just had a plethora of businesses in there. And so by having a park with, that diverse of a group, really makes it, a very good, very valuable asset.
And for people who don't spend a lot of time in this asset class, I'm curious to dig in a little bit on the usage. I mean, is this mostly a substitute for some kind of commercial real estate shopping center, where there's a lot of service businesses, and even, as you said, food retail? Or, is this more of an industrial warehouse logistics asset class? I'm just curious, like which way it leans, and if that's even changed at all.
Yeah, no, it kind of leans both ways. That's what's great about it. But it also depends on how you build it, right? So if you build something that is Just has your standard garage door with a walk-in door and it's, straight metal construction. You're really going to get that subcontractor base style tenants, right? Your landscapers, plumbers, electricians. But, if you start upgrading the building, putting in maybe, nicer glass storefront, things of that nature, that's when you can capture some of those retail guys. So it really depends. And it's no different than any asset, commercial real estate asset class. It's how you build it is what helps determine, obviously, the audience that you're going for.
And if I'm a customer facing business, not a back end logistics or warehouse business, and I'm customer facing and I meet my customers, at the on site at the real estate, what is the attractiveness of these properties relative to being in a shopping center, being in a mall, or having a standalone piece of real estate on a main strip? What am I getting here that is maybe a little different?
Well, one thing I'll tell you that I hear from any retailer that has come to it, and obviously you're not going to see like a TJ Maxx or something like that in here. These spaces just aren't large enough. I don't have enough parking usually, but what I hear from a lot of the retail guys is they like the rental rate. Usually the rental rate is substantially less, right? And as you know, as technology has continued to improve, especially since COVID, when the online technology and e-commerce just went rampant, a lot of these smaller retail shops, especially privately owned ones, look at it and go, "Look, we don't really get a lot of our business from the drive-by traffic as much as we do maybe word of mouth, social media, internet marketing, things of that nature." And so obviously it's not for every retail guy, but it's very niche specific. Is a lot of those guys come into it. Commercial kitchens have obviously exploded across the country as well. But we do see a lot of the retail guys that come in, and a lot of them say we don't rely on drive-by traffic, and also it's a lot friendlier on the rental rate side.
And if I'm thinking about where these things are typically located, are we talking about these are mostly on the outskirts of town in former industrial areas? Is that a good profile of that, or is that would that be an unfair characteristic?
I mean, I think it's a good profile. Like you do see them in heavier industrial areas, right? You do see them in, a lot of the outskirts. You see them in a lot of areas that have a lot of new upcoming developments, right? Where there's a lot of new homes being put in. There's a lot of times you'll see these, just like you'll see self-storage facilities. And so these things really kind of go anywhere. Obviously, if you're going to be inside of the city limits, you're going to have certain zoning restrictions that, may or may not allow you to go in there. But there's really no specific area, but I mean, they're really popping up everywhere, all across the U.S.
Got it. And you mentioned zoning, and that was my next question was like, what kind of zoning do you need to have in place from the municipality or to get the land changed to fit a potential development in this space?
A lot of a lot of areas are going to be different than. So I want to speak a little broadly on it. One of the main zoning types that we see that works best for it is going to be light industrial. And so, but it also depends on the model that you build, right? If you're doing something a little tailored more towards showroom or stuff of that nature, maybe somebody can get it through on a certain type of commercial or retail zoning. There's certain hot words that, obviously, certain cities that they hear, like fenced in storage side yard, just something like that. Those are things that'll probably trigger you to, maybe either change zoning or, have to find something within that zoning. But we see a lot of people doing these within the light industrial side.
And if I think about a typical shopping center, maybe grocery anchored or, large tenant anchored, right? There's this kind of network effect where the large uh, anchor brings in a bunch of shoppers who then go to the bakery and the post office and all that.
Oh yeah.
I mean, are these mostly standalone and like there's not that synergy between businesses, or do as this developed, have you started to see some more, you know, maybe landlords are being a little more tactical about how they're putting these things together and putting the tenant bases together, so there is a little bit more of a reason for these businesses to be located proximately.
No, I mean, there's not a set rule of thumb, right? It's not like you said, like, a big thing in retail is finding something that is shadow anchored, right? They love using that word where it's like, hey, Walmart casts a shadow over the center, make them profitable kind of thing, where it brings certain tenants to it. There's really no like certain anchor for flex industrial because it's a lot of smaller tenants. But it's not uncommon to see a lot of these guys, um, maybe not so much working together, but working in tandem with people in the community. And I'll just give you a prime example. So the park in Blue Mountain that we sold, I mean, they had a high-end kitchen cabinet company in there, and a really nice high-end pool company, a high-end landscape company. And so it's not uncommon for builders to maybe go to all those guys and use them for their services. But there's not a an anchor deal, which I think actually makes the asset class great because, as you know, when you see a anchor leave a retail center, usually that retail center starts to die off at that point. And so I think that's actually what makes these so great is there's not one thing that can that's running them. And also, if you have something that's really true small bay where you've got a lot of tenants in there, if maybe you have a couple vacancies, you're not going to be as affected as you would as if your large, anchor and retail left.
Got it. And if I think about the demand for real estate assets from institutional investors, my sense is that they like um national tenants with long-term leases, and whether there's an anchor or not, there's the certainty of the triple net lease with a big national tenant. That doesn't sound like that's the case here. How do you think about that dynamic of this is an asset class that really focuses on local, maybe regional tenants versus, getting that really attractive 10-year lease from someone where the corporate's guaranteeing it for 10 years?
And I tell you, that's a great argument. I was at ICSC this past week, and I was actually talking to another retail guy about that. They're like, man, nothing beats these triple net lease properties, right? They like these long-term lease deals. But the small bay side, it's very common to find them with triple net leases on there. But now you're not getting as high of credit generally as you would. But, one thing to keep in mind is, I mean, when you look at the, retail and net lease landscape, I mean, how many times have we been hearing over the past 5 years, hey, this company's topping this many locations. Hey, this company's, exiting all these locations. And so all the times when you buy a net lease asset, I consider those bonds because the price that you're paying per square foot is really not what that project is actually worth. That lease is really worth that value. And so without that lease, that that value always isn't there. And so I think that's kind of the drawback to me. If you're like, hey, should I get something that's a single tenant long term lease or something that has a little bit fewer, a lot more tenants in there? And a lot of times I'll tell you the small bay flex is producing a much higher rate of return than you would find on single tenant net lease assets.
Sure. And I want to make
It's
sure.
to each his own. It's to each
Just
his own.
totally. No, it's real estate. You can choose what you want, right?
Yeah.
And so, but as I think about you've developed an expertise in this space. Maybe talk a little bit about what you do for clients, investors, people who are interested in this space. What is your group really, spending your time doing?
So we have a couple arms on our side. So our main forte is we specialize in selling small bay flex industrial all across the U.S. Right. We also help people do site selection. So people that want to build it, we can help them evaluate and understand the areas that they're looking into. Maybe evaluate land parcels, see if this is good for a small bay flex industrial. Maybe what type of model it's good for. We also do that as well. And we have a small investment arm as well that we love investing in this stuff. Obviously, been doing it 20 years. I'd be no good preaching it if I didn't invest in it myself. So we do that also. We don't create syndications or anything of that nature. We work with several funds in that capacity.
Yeah, I mean, given the the conversations we have on this podcast, we always like people when people eat their own cooking. I think you make an interesting case for why this is a compelling asset class. But I get the sense that you feel like institutional investors have not paid a whole lot of attention to this segment of the commercial real estate market. What do you think is driving that?
Well, so they didn't for a long time, but they are starting to now, right? As you know, Blackstone's the large institutional investor. They actually purchased a big portfolio of small bay flex industrial many years ago, right? They kind of made a really big splash into it. And so you got a lot of other folks that have been looking into it as well. So I think it's definitely on the rise on it. One thing that I would actually compare it to is, and I don't know if you remember this or not, but in the late 90s, early 2000s, self-storage investing was mostly what a lot of people call mom and pops, right? Like small private ownership. Now that's one of the heavier institutionalized owned asset classes. I believe this one's on a very similar trajectory. If you look at how much was institutionally owned years ago as compared to today, that number's risen at a very fast rate. So I think with a lot of factors to do with that. I think with inflation, especially causing a lot of heartache in the office sector, in the medical office sector, in the multifamily sector, that's had a lot of those higher level funds and institutions looking at small bay because when a tenant leaves small bay, there's not as much tenant finish out,
Yeah.
tenant improvements that are done for a new tenant to come in as compared to office space, medical office, retail, multifamily. And so I think that's been one of the big drivers on those guys coming to it because that's what we hear from them is they go, we like it because when a tenant leaves, we're not, spending all of our CapEx or, all of our below the line item money on refinishing out of space. And the, tenant velocity is good, meaning your time on market when you lose a tenant, getting it released is very good. So there's a lot of good factors that are bringing these guys to the space, and I think it's going to be a very good next 5 to 10 years.
You made an interesting comparison between this asset class and self-storage. My guess is that in general, as a real estate asset class gets more institutionalized, cap rates come down
What it did
over
in
time.
Colliers.
So tell me tell me that story if you know the numbers, even kind of anecdotally, of like where were cap rates in the self-storage space in the late 90s versus where they are today. It'd be an interesting kind of maybe potential anecdote that will highlight where the opportunity is in the flex space.
I don't really know where they were in the 90s. I was busy watching Stone Cold Steve Austin and The Undertaker go at it. But I could take from anybody that I've talked to. I mean, it's compressed it quite a bit. I mean, it's one of the more compressed cap rate asset classes that you'll find right next to multifamily, right next to, single tenant net lease. And it's heavy institutionalized. It's got a lot of followers in it. They've got a huge um, uh, several associations that people are part of across the U.S., TSSA, and all those other guys. And so, but a lot of those folks, I'll tell you, Trey and I went to the Texas Self Storage Association not long ago, and there's a lot of people from that side even coming over to it. And so, a lot of the buyers that we're getting for the small bay are not your traditional small bay guys. These are guys coming in from all other asset classes, which I think is why it's, such an exciting asset class right now.
One of the criticisms I have about the institutional investment community is that there's this unhealthy focus on boxes. Like, what box do you fit in? And on the investing side, it's like, are you a value investor? Are you a growth investor? Are you a small cap or a large cap? Are you international or US? And in real estate, I think it's like, are you multifamily? Are you industrial? Are you retail shopping center? And if there's no people have trouble with things that cross boxes and don't fit squarely in there. Do you think that's part of the issue is that this hasn't fit neatly in one of the institutional boxes?
I think so. And I think there's a few boxes in there that they don't like. Some don't like some of the construction material, right? Like some of the metal projects. They don't like some of them, obviously don't like the tenant credit or the, lease terms, which, all of these are 1 to 3 year leases. But like I said, I mean, we've seen their comfortability, really start to wrap their arms around these more and more. There's real estate funds then that years ago, if we'd have brought them a metal park in the middle of Dallas, they'd have said no to. And, one of them, we actually laugh about it all the time now, but we just sold them a bunch of metal stuff out in West Texas. And so that shows how their parameters have expanded and really, embraced this asset class.
And from what you can tell, how institutionalized is this asset class today?
It's very little. It's probably 20%.
And how does that compare to other things, just for some context?
I'd have to look up, multifamily on a national level. But I want to say on storage, I mean, you're probably easily at 50%, I would imagine.
Yeah.
You got a lot of new build on that side too that just continues to get built.
So, I want to talk through some of the attractive characteristics about this asset class. You highlight a number of them that I want to go through kind of one by one. So let's start with low tenant turnover. I guess I would have thought that turnover rates would be high given the local nature of these tenants. Talk to me about why turnover rates would be lower than, maybe someone would think at first blush.
Yeah, well, a lot of these are small businesses, right? So they're very dedicated, they're localized, it's, utilized for their business, their space. It's there for a reason. It's not like self-storage where it's just kind of really temporarily used. It's also not uncommon for the tenants to put a lot of their own money into the space.
Yeah.
And so, I'll give you a prime example. There's one that had a tumble insured tenant in there, and they spent well over $100,000 of their own money on the space. So that's a lot of dedication from a tenant in that space. You have a lot of markets. We were actually looking at one a couple days ago where it had an 82% renewal probability rate, which is very, very good.
Yeah.
And so it's it's there's a lot of factors to it. A lot of dedication to the space, dedication to the area. But it's got a very good tenant retention percentage.
Is this a space where landlords actually ask for personal guarantees on leases, or is that not common?
Our guys do, yeah. Our guys do all the time.
Got it.
It's you don't always get it, obviously, but our guys definitely do.
I mean, I would assume if you have a personal guarantee, you're going to really care about, how well the location does, and you're going to make sure that it, to the degree possible, you're going to make sure that you can stay in that space.
Yeah, and if they don't sign a personal guarantee, we usually figure it out. Why maybe there's certain things within the company. It's not a problem to get larger companies to put out satellite branches in some of these parks as well. And obviously, many of those aren't going to be personally guaranteed, but it's not uncommon to get PGs on the leases.
Got it. And you mentioned, I think that, a lot of these leases are 1 to 3 years. From the tenant's perspective, what's attractive about such a short lease term, do you think?
I think it's more on the landlord side more than anything because you have a lot of markets that have had a lot higher year-over-year rent growth than what's in the leases,
Sure.
than what's in the annual increases. And so we never recommend anybody doing over a 3-year lease, unless maybe it's a larger tenant and you are spending money in there, then, sometimes that needs to be recaptured. As far as a tenant goes, that's just really flexibility on their end. I think a lot of times it's a little bit more risk on their end, but just because a new landlord can come in and really, maneuver rates up. Because the good thing about the small bay side that you won't find in as many other asset classes either is there's still a lot of existing value add that you can buy. And so, prime example, we did a park on 287. Their rent had to be 35% below market. So that group that bought that, they went in and they just started, raising rates. And, you know, they obviously, if the leases were too long, it could have been an issue, but luckily it just had, 1-year leases on it. So, it doesn't obviously benefit a tenant as much, but it's something similar that you see or that you did see in multifamily for a while. I think up until recently.
Got it. Another thing you highlight about that's attractive about this space is the low operating costs relative to other
Yeah.
asset classes in real estate. Talk to me a little bit about operating costs and how they compare.
So as you know, whenever you have a real estate holding, even if you're completely vacant, you have an operating cost, right? You got your taxes, insurance. If you're running, multifamily office retail, you're gonna have utilities in there a lot of times. I mean, you're gonna have a lot of little things in there. As far as small bay flex goes, a lot of times we're seeing these at their break-even cost with that loan, obviously, at around 25%, 25, 30%. So they're very low operating costs because there's not a lot of things to it. And, most of the spaces spaces are separately metered in a lot of cases. So they're paying their own utilities. There's not a lot of maintenance on these buildings. So a lot of the expenses that we're seeing on landlords are taxes, insurance, and a little bit of common area maintenance. And if you have triple net leases, then obviously you're getting a portion of that bill back. But it's very similar to storage, but without as heavy of a property management.
Got it. And we haven't really talked about build costs yet. I'm curious on the new build. Like, what is it? Sounds you're not building, kind of on, the main and main in most cities. It's kind of real estate costs should be lower. It's also not like heavy amenities. So I'm just trying to get a sense of like, what does it cost to build one of these today versus maybe some other asset classes in real estate are a little more expensive.
So, it's not uncommon to see, office or MOB or some of these others being, $300 a foot, multifamily at, 80, 100,000 a door, whatever theirs are running. As far as the build cost goes on these, there's several that we're working on that with the land, they're ending up around 115 to 125 per square foot. As far as the actual, just the shell itself, I mean, those really aren't that expensive. Those are, around 26 to 32 a foot.
Yeah.
And then it obviously depends on how much concrete, parking you're doing. And if you're doing the showroom glass, it's, running around $50 a foot on that side. But I mean, these things can be very cheap, but they can also be very, very expensive builds as well. And so you can go into higher areas like a McKinney and other areas that, have high dollar rents and all other asset classes and build these. And really, it's not uncommon to see somebody throw down $170 a foot on it.
And obviously there needs to be a return.
Their rental rate needs to make sense, obviously, at a point. So they're not building 170 a foot to get $10 gross. I mean, they're doing it because they're out there getting, 18 to 20 plus net.
But I guess the question then is, you mentioned the rents are lower. I think that makes sense. Anyone can understand why that would be the case. Build costs are lower. From a pure development perspective, the returns on that capital are still high enough from your perspective to just, the relative, given the low rents, to justify even spending 100 to 150 a foot.
Yeah, I mean, like that's why I would say whenever somebody's looking at it, we always say if you're trying to find, if you want to build a new park, we always say to back into it, right? So figure out the model you want to build, get the price on that. Then that tells you how much money you can spend on land and then what rental rate you have to get to achieve a good return.
Got it.
We keep it easy over here, Ben.
Yeah, no, hey, look, that's the way to do it. I like it. Keep it simple.
Yeah, we got some people that come around and go, "Hey, yeah, what do you think about this land?" And we're like, "We're not going." Well, what if I do this? What if I change this? It's like, why don't you build the model you want, and we'll find you an area that can get the rate that you need.
And so let's say that I'm looking at acquiring an existing property as opposed to building a new one. What kind of cap rates do you see in the market today? And, for people who don't focus all the time on real estate, I'd love for you to just throw some other numbers out there, maybe in multifam or storage. Like what kind of cap rates how do the cap rates compare in Flex Bay versus the other ones?
So I got a couple of good friends in storage. It's not uncommon to see them, going high fours, fives, sixes. Multifamily can be very, very similar as well. Obviously offices on the higher side, retail. I mean, I'm sure you've probably seen, those things can get as low into the fours as well, depending on, if it's a Chick-fil-A or McDonald's or something of that nature. As far as the small bay side goes, I'll give you a range. It can be around 6 to 8. And that can be dependent on, between infill, quality of build, and, value add aspect to it. Obviously, we've done them, much less than that if they had a lot of value add to it. But you can find really good parks in the mid sevens.
Got it. And, taking a step back and thinking about what's driving demand, are there any macro trends that you feel are additional tailwinds for flex industrial real estate today?
Yeah, new home construction, I think, is one of the best drivers for it, and is a lot of the major metros continue to do this, right? Continue to expand outward. You're seeing more and more parks being built in those up and coming areas where a lot of those homes are being built at, because like it's different from when we were younger. Like when we were younger, did you ever really hear of master plan communities? And did you ever hear of new home developments dropping 4,000 homes? Like that just didn't exist. And so now it's a thing that does happen, and so these run very very well off of new home construction.
And if I'm a developer and I see a master plan community coming in and I say there's going to be kind of embedded demand here for services and goods, what's my calculus between let's build a traditional grocery anchored shopping center versus a flex space? Is it really about the rents you can get? I mean, it would seem to me like most developers would go with what, how this country was built was like you build houses, then you build retail, then restaurants. You know what I'm saying? Like how do you see developers making that call today?
Well, I think it's easy. I mean, not everybody can go plop down a large retail center, especially an anchored retail center. There's a lot more people that can go throw down 50,000 square feet of metal constructed flex warehouse for just a couple $1,000,000. And so I think that's really probably your biggest difference there is the actual developer, because a lot of the developers that are doing this are smaller private guys, right? They're not as big of players, like ones that do the larger shopping centers.
Got it. Another thing that you highlight is kind of the intensity or the complexity of managing these assets. I mean, I would, the contrarian in me would say, yeah, everything you're saying is great, but these are local mom and pop tenants and they're there for 1 to 3 years. And, if you don't have a personal guarantee, like, there's not a lot you can hold them to. And there's a lot of ins and
Yeah.
outs. So, I mean, that doesn't sound easy to manage to me. What seems easy to manage to me is, signing a 10-year lease with a Walgreens, right? So I'm just trying
And
to get a sense, like what would I get that's not as capital intensive as something like an office space that requires all those amenities and whatever, you have to redo the bathrooms very frequently because people will leave. But why would it not? I just don't. This doesn't feel like an easy asset class.
I'm telling you, I'll tell you exactly why. So, one of the main reasons, we'll just compare it to multifamily, because we sold a couple of these to a multifamily group, and their managers love it. They're like, we don't get a single phone call out after 5. Racked up to multifamily, phone calls light up. I mean,
Yeah.
I bought a bunch of rent homes back in the day, and you know, it seemed I've never had so many water heaters and dishwashers break. I've never had a dishwasher in my life break, except in rent homes that I owned, and so they loved it. They didn't get any calls after 5. Most of the tenants, if there was ever a problem in their space, depending on the lease, the tenants would take care of that themselves. So you're really hands off on it in a lot of cases, and doing the bookkeeping, maybe making sure the landscaping, stuff like that gets taken care of. These leases can be very, very landlord friendly if you do them correctly. But I think they are. I believe, and I'm not saying this because I do it, but I think they're one of the easier asset classes to manage. Obviously, net lease, where they, it's one tenant, one thing. That's a little bit different. But yeah, it's not uncommon for the tenants to take care of their own spaces, so you're not getting those after hour calls.
Sure. And if you take a step back and you think about the circumstances that could hurt returns and rents per square foot in an industry, is a lot of capacity coming online. Let's talk a
Yep.
little bit about the supply and demand dynamics. If you can opine on the whole US, that's helpful, but or even just, in your markets, that what do you see in terms of that balance between supply and demand?
So I actually have a little printout here. So your current vacancy rate across the U.S. is sitting at about 6%. That's slightly up over the previous period of 5.8, and that's because a lot of new construction came online. And flex is when a lot of the new construction comes online, it's vacant, right? It's a lot of it's not pre-leased, so when it hits, it's just at the vacancy. Um, but you've got a lot of markets that, are doing much less than that. Some obviously are a little higher. It just depends on how much being built. Obviously, it's like any asset. It can get oversupplied in certain markets. I know several markets. I even know several markets in Texas that have seen some oversupply, housing saturation. which is still waiting for that area to catch up to all the build that went on there. So anytime you're doing that, what I would tell people, if you're building something and you're worried about saturation, if you're going into a new area and you go, and there's a lot of land out here, it's all ETJ, it's the Wild West, anybody can build anything. We always say, look, you need to amenitize your park. You need to make it something that nobody else will. Because a lot of those guys that are being built, 80% of them are the basic, efficient builds, right? Just the straight metal, nothing really to it. So we tell people, look, maybe add some, some signage opportunity. Maybe 100% HVAC to the warehouse. Maybe do mezzanine space. Maybe just a storage side yards. Those are huge. We raise the ceiling height a little bit because a lot of people actually underestimate the ceiling height aspect. And we're closing on a park right now that has about 20 feet tall ceilings in it. And the tenants that they have in there really couldn't be anywhere else because of that height. So they've got a basketball training facility in there. They've got the pickleball guys in there. I mean, they've got tenants in there that those tenants can't go to 16 feet. And you really can't even do mezzanine space under 18 anyway. Sure. So amenitizing a park can help insulate you from potential competition.
And
that's my take.
Yeah, no, that's helpful. And if I'm interested in this space and I'm looking for markets that you feel like are attractive versus less attractive based on that supply demand dynamic, I'd love to hear just from your own perspective, where you think there is opportunity versus places that, a new investor in the space might consider staying away from.
Yeah, no, perfect. So let's hit a few. So California is sitting on the most flex square footage of any state, which they usually are on any asset class. Their vacancy is around 11.5%. They've got over 10,000 properties. Texas is a very good state, very good velocity state. Obviously, it's very large, so there's a lot of areas, a lot of opportunities for that. Florida is another good one. They sit on a very low vacancy with very good tenant velocity, meaning they've got a very quick timeline of filling up space. A couple of the key markets that people don't really think of: Tennessee, Nevada, Utah, and Arizona. Those have very good vacancy rates and very good tenant velocity as well, with good increases. And so, another state too, there's a lot of people that love Colorado. We call that the metal building mecca of the U.S. They're over 11% on the vacancy factor. And that's just because so many people keep going out there and dropping buildings down. And so, but obviously each area is, specific. So you never want to just say, oh, all of Colorado is that way. I mean, there's obviously areas that you can do. And then, depending on your investment criteria, if you're building to rent and hold, that's one. If you're building to rent and then sell and profit, that's another. And so, understanding some of those markets as well, because like we say, Oklahoma is a fantastic cash flow market, right? You go out there, build, or you can buy existing. Those things cash flow, they do very, very well. But when it comes time to sell, they usually don't bring as much as, maybe your Florida or Texas or other markets. And so, those are all factors to keep in mind.
Seems like the attractiveness of a market, at least is at least loosely correlated with where people are moving, right? Florida and Texas, Tennessee, I think
Nevada's seeing a lot too.
Nevada have been net, a lot low state taxes or no state taxes. So you think that's part of it? I mean, obviously there's the supply and demand of physical real estate, but but you also mentioned that new houses are important and some kind of population influx is a driver, would you say, of to some degree how attractive these markets are?
I think so, because your Texas market, Florida, Nevada, Arizona, those have seen a massive influx from California and to other areas, and that's continued to help those economies.
Got it.
We see California plates out here everywhere now.
Yeah, well, being a Californian, but I get it. I understand it.
Well, I'll tell you real quick. We actually sold some to a guy in Plano who was from California. And when I first met him, he flew out here, and he loves California. Loves the weather, everything like that. After coming out, he bought this project. After coming out here so many times over a couple of years, he actually moved his family out here, and he says he loves it out here because he hates the weather, which there's nothing we can do about it. It's hot everywhere.
Yeah.
But he loves it.
Yeah, no, I get that. And so you mentioned that California often has like the most vacancies versus other markets and but also has higher rents per square foot. I'm just trying to figure out that mix is like, people build more in California because the rents are higher, but and that of course means that there's oversupply. Like what's accounting for the variation that you see in terms of vacancies and rents per square foot in these various markets?
Well, like when you take California example, it's kind of similar to Washington and surrounding areas of New York. I mean, you look at the graphs of the past few years, and it's kind of doing this, right? Because you have maybe a lot of supply that comes online, which causes the vacancy to rise up, so that gets leased, and then it just kind of keeps doing this. So it's markets that just kind of continue to have waves, and then also those states have their own little economies too, right? It's very similar to West Texas. So people come out here and they buy in West Texas, and they'll go out there and they'll go, "Man, this place is great. There's like 10 million vehicles out here. There's oil being pumped everywhere. Like it's just business crazy." And then you go out there a year or so later, and it seems like it's dead. And it's because that market comes and goes with the energy sector
Yeah.
of the United States. And so, we feel stuck out there as low as $80 a foot as high as $150 a foot, depending on the economy. And all that stuff can happen very, very quickly.
Got it. Okay. The other thing that I'm curious about is, how you distinguish different properties. So these are already existing properties. So, what's the difference between what you would categorize as a 1 or 2 star property and one that looks more like a 4 or 5 star property?
So a lot of that's going to be the way the building looks and location and amenities, right? So if it's your basic metal, no glass, rural area, that'd be a C product. Nothing wrong with C product. We love C products. But when you start adding into showroom glass, maybe get a little bit better location, maybe raise the ceiling heights, nice parking lot, standardized signage. I mean, then you start to kind of get into the B product. And then, when you start getting into the A, you really start having a lot more glass, maybe a tilt wall or brick or some kind of masonry, exterior. And, those are the ones that you'll see a little bit more higher end tenants and in higher end areas.
And what about common area amenities? What do those look like you know,
Very, very, very little. Some the common area amenities that you will see will maybe be covered parking, maybe some storage units for some of the businesses to use. But these things aren't big on common area amenities because a lot of them. I mean, you walk in, you go to the spaces, they have their own restroom, they have their own office, so there's really not a lot of sharing stuff.
Sure.
Some of the higher end facilities I've seen have shared conference rooms and things of that nature, but that's only on the higher end stuff.
Yeah. It also stands to reason that, in a post-COVID world where more people have a hybrid or work from home situations, that a lot of people, maybe got tired of going to the 7-story office building and being on the 6th floor and just kind of like in an industrial, like an office park. Do you,
That's what that logistics company said, actually, the exact same thing, man. There's a park that we were working on, there's a logistics company in there, and we said, "What made y'all move here?" And they said, "Man," because they were in downtown Fort Worth, and yeah, that's a tough place to be. We used to be down there, and, you're parking in a garage 2 streets away, paying for parking, then you're going up, several floors. We were on the 15th floor there, and they said, "Man, we got tired of walking. We got cheaper rent here, and we drive right up to the space."
yeah. I mean, that's what I'm thinking. You could have a cool office space that's very different than the traditional kind of, whatever standard office fare that you see in downtown cities, right? And you could have
Oh,
like
yeah, they had an
a
open
collaborative space.
concept. Oh, yeah, they had an open concept like we have here, the traditional enclosed offices. I mean, that's kind of a thing in the past. I mean, you still see it, but, parking become a really big deal, but no, they liked it. They had a great open concept. They said, "We love it. We pull right up to the front door, and we don't have to fight all the city traffic," and it just made all the sense in the world to them, plus cheaper rent.
And I know that you put your own money into this, so this is going to be a relevant question for you. But I'm just curious, are you kind of a value buyer where you buy something and try to make a 2 star property better? or is this an asset class where you kind of want to be, it's worth paying up for a 4 to 5 star property and managing that. Where do you think you sit on that, like, quality versus value spectrum?
Yeah, I like the value add side because, whenever you're getting something that's kind of fully stabilized, high and whatnot, they are kind of at their peak in a lot of cases. And yeah, they may see that, annual growth and things of that nature. But I like going into something where it's like, all right, look, here's our bottom line. The building's at its bottom line pretty much. And so all it can do is better if we continue to improve it. And so I like that. But also with new development, there's a lot of opportunity on new development as well. And so you've got several different ways to get in on it.
And, one of the things the institutional investors, whether it's a Blackstone or, a pension or, an endowment, they're going to need to put a lot of capital to work, right? They're not writing, $2 million checks. They're not writing $7 million checks. They want $100 million checks or more. Are those, I mean, to become truly institutionalized, you need big assets that can be acquired either, whatever, just, a group that has 100 properties or 50 properties or something like that. I mean, has it consolidated enough? Are there big enough players in the space where, the institutions can actually put a lot of money to work?
There is, yeah. And there's a lot of funds that are collecting properties to sell to institutions.
Got it.
And so there's several funds that we work with that go out and buy the smaller stuff so they can package up in a portfolio to sell off. And so that's been a big thing over the past few years as well.
Got it. No, that makes sense. That makes sense.
Yeah, because it's hard. Yeah, it'd be hard unless an institution comes in and buys a portfolio of stuff. They're not the ones that want to come in and buy a 50,000 square foot park.
And is there a cap rate arbitrage where I can buy a bunch at 7 to 8, right, and individually and package 50 of them at 6 to 7, and so you potentially get the value add plus kind of multiple expansion because you've packaged? Is that part of the strategy?
Yes, that is. So a lot of them do it because they see that cap rate compression once they get, obviously up to a certain number of square feet or portfolio value. Obviously it's tailored to the institution and what they're trying to do. But that's the main driver for a lot of those funds to do that.
And do you see the guys who are doing that and kind of buying up assets? Are they doing it region specific? Are they doing it nationally? I'm just trying to get a sense of how diversified
Yeah.
that is.
So a lot of them are in, a lot of them are in major metros, right? Because institutions really aren't wanting to go play out in the outskirts, on stuff. And so a lot of them are doing it in major metros, not messing in the outskirts. And a lot of them are really trying to stick to, masonry, tilt wall, something non-metal if you're selling to an institution, unless it's a higher end, obviously. But yeah, those people are mostly in fill locations right now.
And are these situations where these funds are buying these things and hiring CB Richard Ellis to manage them? Or is this an asset class that, even if you're located in California or New York, you can manage something on the outskirts of Chicago without needing a whole lot of local representation? I'm just thinking about local leasing and how, intensive that is. How do you see these funds and the institutions? How are they managing these properties from what you can tell?
So as far as the management side goes, that's the best thing about it. You really don't have to have a larger company, like a Colliers. I mean, you can obviously no problem, but the property management side seems to be, a little easier for a lot of them. And the good thing about major metros, whether it's, Atlanta, Houston, DFW, I mean, you can go a property manager and hit 10 more. So there's plenty of opportunity on that side. And as far as the leasing side goes, I'm a big believer of the owner leasing it because a lot of times you're dealing with the tenant, B2B, you're like right here, just like you and I are. And so deals could be made a lot easier. Sometimes hiring national, larger branded companies are not the best for it because the people that do the best in small bay are the ones that only focus on it, right? Because you got to do a lot of leases to make, good money. And so even when I was leasing, I mean, we were doing 60, 70, 80 leases a year. That's the only way you can do it. And so if you hire an agent that, maybe leasing a small bit over here, leasing an office building over here, trying to sell people in over here, that's not going to be your best route to success. It's finding that niche small bay guy, which in many cases they work for smaller companies.
And that leads me to an interesting question about the learning curve here. Let's say that I've spent my career in office or multifam, and I'm looking at this and like, this is an interesting space. Don't know much about it. What do you think the learning curve's like to be able to manage this versus other real estate asset classes?
And from what I've heard, anybody that comes to it from any other asset class, nobody's really had a lot of issues with it. I mean, obviously, if you're building new construction, you're always going to run into stuff, especially if you've never done it before. Um, but I believe the learning curve in all of asset classes, it's got to be one of the easier, especially if you're getting triple net leases. It's a very friendly asset class for the starter investor.
Interesting. And you and your team recently wrote a book on the flex industrial investing space called Flex Space Domination, which I love the
Yeah, we
title
got a
there. Yeah, Flex Space Domination.
I love it, man.
Yeah. So why did you? Obviously, I think you've got this desire to evangelize this space, but what else? Why did you write this book?
So we wrote the book because we're doing so much site selection for people all across the U.S. And I've got a team of 6 guys, a phenomenal team. And we did it last year because we're like, man, so many people call and go, hey, what is Flex Day? What is small bay industrial? How do I learn more about it? So we said, you know what? We're going to take all of our knowledge that we all have. We'll put it in this book. We'll make it an easy read. We're not the most highly educated guys anyway, so it's a very, very easy read. And we say, we're gonna make this book and we're gonna give it out to people that, call and need or whatnot. Well, we spent a lot of time on it, and so we said, you know what, I think we got to go on Amazon instead. And so, but it's been a very good book. We sent it out to a lot of folks. I mean, it probably sells 3 to 4 a day. I mean, but it was done to kind of help the intro person to kind of learn and understand it, understand tips and tricks that we have, things that we've seen work well, mistakes that we've seen to just try to help somebody get started on their small bay journey. But I'm glad you like the name.
Yeah. What's been the feedback on the book that you've gotten?
It's been great. It's probably the only book in the arena. As you know, if you Google, you know, residential investing or multifamily investing, it's going to be a library of stuff. This is probably, as far as I know, the first one into the side. So unfortunately, a lot of people don't have a lot of options on it. So I think that's been the best part about it.
And have you gotten more inbound because of it? They like someone who you didn't send the book to says, oh, wow, who are these guys? Like they're the experts here.
Oh, we get calls from people all the time, all across the U.S. Hey, got your book, love it. Want to reach out to you, see if, you have any thoughts on this land or what do you think? Can we do an evaluation? And so we also used it to, kind of help leverage us to meet out and reach out to more people.
And you have such a long history in this space. I'm curious about the mistakes that you've seen people make here. And I'd love to hear just some anecdotes for someone who's interested in investing in this space. Like what kind of mistakes should they be really careful to avoid making?
Well, no, call mistakes. I mean, look, I make mistakes all the time. Like that's just part of life, right? I think one of the biggest things, and I'm sure you've seen this and you'll understand is not having the right team around you and kind of just going it alone. Because especially if you're going to do a new construction deal, I mean, and it's not having like a good civil engineer, all these good, subcontractors that good developers, people like this. I mean, it's about putting the right team around you, and that's what we actually help a lot of people do. Because I have the right team around me. I mean, if I didn't have these guys, I'd be making mistakes left and right even more. But that's probably the biggest thing that we see is people call us and go, "Man, I ran into this." And we're like, "Man, you needed, who's your civil engineer?" "Oh, I was doing it on my own, and I was dealing with the city on my own." And that's really the biggest thing that we see. And then some people buying land more on emotion than actual, through the business lens as well, which, I mean, that happens to all of us. I'm a car guy. I've got a bunch of classic cars. I bought old cars on a whim that were pieces of junk that I thought were going to be good. And so that's just how life goes.
And what about on the acquiring existing properties side? What kind of pitfalls are there for potential investors?
I think understanding where the market is in rent and where you can actually get the tenants to. And so sometimes whenever you have people not from that area or from other states come in, thinking they can go boost rents a little more than they can without doing anything. I mean, but that, I mean, you see that happen on the multifamily side. You see that happen anywhere, right? It's very easy to run tenants off, if not increasing the right way. And so we've seen that happen plenty of times.
And what kind of attrition do you usually see? I mean, I think you cited this opportunity where someone raised rents by 35%. That's a big, that's a big,
Big jump for a small business.
yeah, really. I mean, for a small business, that could be the difference between profitability and not being profitable. Like, doesn't that become self-defeating pretty quickly?
Yes, but I mean, there's also ways of working it too. So, one thing that one of our lease guys is doing on the park right now that they picked up that's really under market is, they went to the tenant to me. They're gradually increasing a little bit more than they, typically would, but it's also like, hey, this is where our rate is going to be in the next year. So if you can't make it, that's great. We'll put you on this lease, and about 6 months prior, we'll try to lease it out to someone else that can maybe pay that rate. So it's setting up the right leasing game plan and not just going to them and going, "Hey, can't pay this rate, get out." It's doing it in stages and having the right game plan to execute on whatever rate you are trying to get.
And if, what you have, I think, a great perspective and a purview on this industry. There's a lot to like about it. What is there to not like about it? What's the flip side of some of these arguments?
I mean, yeah, I mean, it's worked. That's just all there is to it. I mean, any real estate investment is going to be some work. Um, you know, uh, I only know positives on it. So the only negative I can think of is you just have to work at it.
Yeah, okay, that's look, it's a there are many worse things in the world than.
Not a bad, yeah, it's not bad at all. Either way, you're gonna have to work at something. So
Well, Cody, this has been a really interesting and fascinating discussion of something that I don't know a whole lot about and didn't know a whole lot about before I started talking to you. So we'll
well,
close.
now you're an expert, man.
I know. All I have to do is read your book, and I'm going to start doing developments. Uh, but we'll close with our favorite question, and the one we close all of our conversations with is: what do you think people are underestimating about the investment opportunity in flex industrial space today?
Timing, because of the trajectory that it's on, especially on new builds and things of that nature. It's one of those things that, I mean, look, if you got into it a few years ago, you'd be so much farther ahead than you are today. And so it's just about acting sooner than later.
In the idea being, there's demand. There's probably some cap rate compression coming over time with institutionalization. And then there's the learning curve that you have to get to as a new, kind of a new player in the space. So, with all of that being true, the idea is your point is it's just really important to focus on doing it now versus in 3 years, 5 years, 7 years kind of thing.
Yeah, because I mean, there are parks that we sold a few years ago that are worth 25% more today.
Yeah.
So, but I think it's got a good 5+ years run left in it. It's on a very good trajectory.
I mean, it's interesting that you can have, the opportunity. It's not a lot of situations, I think, where you have a lot where there's the kind of a general compression of cap rates and this high turnover lease construct where you can get up to market really quickly, right? So there's value add plus rate compression. That's how you, I think, make a lot of money in real estate.
Yeah, no, I agree.
Well, I think that's a wonderful place to close. Cody, thank you for being on Compounders. I think you probably educated just about every one of our listeners on this asset class. So appreciate that.
Yeah, no, appreciate you having me, Ben.